From time to time, I-bonds are a great investment. From May to October 2022, I-bonds paid 9.62%, which is the best return you can earn for no risk. From November to April 2023, the rate is 6.47%, which is still an excellent rate of return that has no credit default risk. But there is a good chance that the interest rate for the following 6-month period will be low, less than 3%, maybe even 0%. I will explain why I-bonds may be a poor investment after October 2022, especially because better investment opportunities are coming shortly. I will present my forecast for the stock market for the last 2 months of 2022, when I think it will hit bottom, and I will explain my basis for the forecast. I will also show a way to benefit from a good interest rate with a potential for great capital gains, all for low risk. When inflation spikes, the Federal Reserve starts raising interest rates to cool the economy. This often results in recessions. Aggregate demand drops, then prices drop. Even deflation sometimes results. In this chart, you can easily see the relationship between inflation spikes and the following recessions, presented as gray bars in this chart. Many economists are forecasting a recession within the next 12 months. And there are other signs that prices are dropping or will drop shortly. Lower inflation, or even deflation, means that the composite interest rate in I-bonds will probably drop substantially. So, the interest rate in I-bonds will likely be low in May 2023, probably less than 3%, maybe even 0%. Why? The Fed will keep raising interest rates until inflation is curbed, possibly causing deflation from inflation highs, especially if the economy enters a recession. This period of low interest means that recently purchased I-bonds will have a substantial opportunity cost. Bonds must be held for a minimum of 1 year. If redeemed before 5 years, then the last 3 months of interest is forfeited. Therefore, you may suffer from 6 months of low interest, even as Treasury bills are paying 5% or more. The interest rate for I-bonds is a composite rate of a fixed rate and a variable rate based on inflation. The fixed rate has been 0 for a while and will remain so until at least May 2023. The I-bond variable rate is set every May and November based on the most recent 6-month period for which CPI data is available. This is the formula for figuring the composite interest rate. Currently, since the fixed rate is 0, the composite rate consists only of the semi-annual inflation rate, which is annualized to make it easy to compare to other investment returns. The variable component may be negative because inflation may be negative. If the inflation rate is negative, then the second and third terms in the equation to determine the composite rate will both be negative, which means that the second and third terms will be subtracted from the fixed rate. However, I-bonds are guaranteed to never lose money, so the composite rate will never be less than 0%. If the fixed rate is 0%, as it is now, then the annualized composite rate equals 2 times the applicable 6-month inflation rate. So if inflation is low, then the composite rate will also be low. Since I-bonds were introduced in 1998, there have been only 2 periods when the inflation rate was negative. The biggest decline in the inflation factor occurred during the Great Recession in May 2009, 2 months after the stock market reached a bottom. And right after the dot-com recession in 2001, the rate was only 0.28%. But there were many periods when the inflation rate was low, as you can see from these 2 tables, listing all the annualized interest rates based on inflation for all I-bonds issued since 1998, when they first became available. From 2012 to 2020, annualized interest rates were less than 3%. Often, they were less than 2%. In early 2023, there will be some great investment opportunities, including the stock market and the Vanguard Extended Duration Treasury ETF. I will explain why I believe these will be some of the best investment opportunities in 2023. At the beginning of 2023, or shortly thereafter, the stock market is likely to reach bottom. The stock market will probably trend downward in the last 2 months of 2022, but with some bear market rallies. Stocks will probably decline because interest rates will be higher. If the Fed has not stopped raising interest rates, then the market may rally during earnings season, up to about mid-February. But then it may start declining again if interest rates are still rising, just as it did in July and the latter half of October, even though it was clear that the Fed would continue raising interest rates further. Once it becomes clear that the Fed will not raise interest rates further, then the stock market may have one of the biggest rallies in recent times. While it is impossible to predict the stock market, it is much easier to predict interest rates, at least in the short term, because the Federal Reserve controls the federal funds rate, which controls other interest rates, and the Federal Reserve regularly publishes notices as to how it assesses the economy and what it intends to do. While the Fed does not publish how it will change the federal funds rate before changing it, it is fairly predictable whether they will increase rates or keep interest rates steady. Their main reason for increasing rates is to control inflation, and the inflation data is released before the Fed changes the federal funds rate. If inflation is high, then the Fed will probably keep increasing rates. If it is moderate, then they may wait before increasing rates again to see if inflation keeps dropping until it reaches their desired rate of about 2%. The federal funds rate influences bond prices because it also influences other interest rates, causing the other interest rates to move in tandem with the federal funds rate. For instance, as you can see in this graph, the changes to the bank prime loan rate closely parallels changes in the federal funds rate. Higher interest rates will depress both stock prices and cryptocurrencies. Debt becomes more expensive, so assets may be sold to lower debt. People will use less leverage in investments. Less buying, even if selling remains the same, will lead to lower prices. Reduced asset prices will trigger margin calls. Many people will choose to liquidate their positions amidst uncertainty. More money will be transferred from stocks and other risky assets to safer assets paying interest, especially treasuries. Housing prices will decline because mortgages become more expensive. This chart better shows the sharp decline that occurred in the last 3 months of 2018, when the Federal Reserve was quickly raising interest rates. But the stock market recovered in early 2019, when the Fed indicated that interest rates would not be raised further. One reason the stock market dropped so much in 2018 was because it increased steadily from March to September. I believe the same basic pattern being displayed here will occur again from November 2022 to April 2023. At the beginning of 2019, the Fed announced that it would not raise interest rates further, so the market climbed significantly even though interest rates did not decline until later. But since the market has already fallen so much in 2022, I do not expect it to drop as steeply in the last 2 months of 2022. I believe it will trend downward during the last 2 months, punctuated by bear market rallies. If the Fed decides to stop raising interest rates in January 2023, then that may be a good time to invest in the stock market. If not by then the Fed will probably stop increasing rates by the first half of 2023, because it will damage not only the United States economy, but also third world countries hurt by the strong dollar, which is used to price imported goods. When interest rates peak, another great investment opportunity will be the Vanguard Extended Duration Treasury ETF. This security, symbol EDV, is an exchange-traded fund based on U.S. Treasury strips, with maturities ranging from 20 to 30 years. It pays a good interest rate that is risk-free since it is based on U.S. Treasuries, backed by the full faith and credit of the United States government. However, because it has a long duration, its share price is very sensitive to interest rates. But this security has a predictable relationship to interest rates since, like other fixed income assets, prices are inversely proportional to interest rates. This ETF not only pays a decent rate of interest, but it also has the potential for substantial capital gains. However, this will only be a great investment opportunity when interest rates have peaked. I do want to point out that this security does have the highest risk rating, but most of this risk results from interest rate risk, which is more predictable than the risk from stocks. If you buy this ETF when interest rates are at or near their peak, then the risk will be considerably less than if you buy when interest rates are near zero. There is some price risk, even when interest rates do not change, but the price does not vary nearly as much as stock prices. A good way to buy the security is to look at how much the price has varied over the past 5 days, then set a limit order to buy in the low range. To summarize, bond prices move inversely to interest rates. When interest rates decline, bond prices rise, and vice versa. Here's an intuitive way to understand how bond prices vary with market interest rates. With a market interest rate of 5%, you buy a bond for $1,000 paying 5% interest, $50 annually. Now you want to sell your bond when the market interest rate has risen to 10%. You must sell for $500. Why? Why would anyone buy your bond for $1,000 paying $50 annually when they could buy a newly issued bond for $500 paying the same amount of interest? They won't, unless you lower your price to $500. By the same reasoning, if you bought a bond for $500 when the interest rate was 10%, then sold your bond when the market interest rate dropped to 5%, you could sell for $1,000, a 100% return. The relationship of interest rates and bond prices is more complex than the previous simplified example suggests, but it gives you a good intuitive understanding of the relationship. Bonds with longer remaining terms have greater interest rate risk. As you can see in this graph, that shows how bond prices vary with interest rates for a 10-year bond versus a 3-year bond. The curves intersect when the bond price equals par value and the market interest rate equals the coupon rate. For instance, if a bond pays a coupon rate of 6% and interest rates decline from 6% to 4%, then the 10-year bond will increase in value by 16.35%, while a 3-year bond will increase by 5.6%. If interest rates increase by 2%, then the 10-year bond will decline by 13.59%, while a 3-year bond will decline by 5.24%. So you will earn the largest capital gains by buying bonds with the longest durations or terms to maturity. Since this Vanguard ETF has the longest duration, its price will increase the most when interest rates decline. This graph shows how interest rates affect exchange-traded funds based on bonds with different terms, in this case U.S. Treasuries. Note that the three Vanguard ETFs based on U.S. Treasuries were affected similarly when interest rates changed from 2018 to 2022. But the ETF based on long-term Treasuries changed in price by a much larger percentage, even though interest rates changed by only 2%. This reflects the greater interest rate sensitivity of long-term bonds over short-term bonds. Thus, long-term treasuries have greater price risk, but they also have the potential for much greater capital gains. Here are some of the investment details for this Vanguard ETF. Note that the 52-week difference between the high and the low is almost 88%, and the 30-day SEC yield is 4.25%, which will only increase as the price decreases with rising interest rates. The security has declined almost 88% during the past year because interest rates were rising, but the reverse will happen when interest rates decline. Here are some additional details. Freeze the screen to study the details. Here you can see how EDV fared the last time interest rates were increased in 2018. You can easily see the sharp rise. Just dropping the interest rate by a mere 0.5% created a capital gain of 46%. Responding to the COVID-19 crisis, the Federal Reserve lowered the federal funds rate to 0% to 0.25% on March 15, 2020. EDV increased dramatically because of the lowered interest rate and the flight to quality, yielding a capital gain of 74% from the low in 2018, earning a decent amount of interest in the meantime. EDV closed at $79 on October 17, 2022, much lower than it was in October 2018 because the interest rate is higher than it was then. And the share price will continue to decline as the Fed continues to jack up interest rates to lower inflation. But even at the price of $79, if EDV reached its previous high, then you would earn at least a 124% capital gain, even while collecting substantial interest. The only real risk here is that the share price may drop in value if the Fed decides to increase interest rates further. But it should not drop too much since any additional increase in the interest rate is likely to be small because of its devastating effect on the economy. More likely, the interest rate will decline, which will cause EDV to increase in price. If the economy enters a recession or encounters another major problem like COVID-19, then the interest rate may drop to near 0% again, which will cause a dramatic increase in the EDV share price. In the meantime, you earn a decent interest rate while incurring little risk. In the meantime, keep your investments liquid. Savings accounts are now yielding more than 3% in some places, and this will increase as interest rates rise. And many banks, such as Discover Bank, increase their interest rate as the federal funds rate rises. T-bills are another possibility, but the small increase in interest rates may not be worth the reduced liquidity. If you do want to invest in T-bills, then create a T-bill ladder with 4-week T-bills by taking your total investment and dividing it into 4 portions. Invest each portion each week so that you can reinvest a portion of your funds each week into better opportunities as they become available. Avoid longer-term T-bills since that will tie up your money for too long, even if you use an investment ladder, for a negligible increase in interest rates. Thank you very much for your time. If you liked my video, please give me a thumbs up and subscribe. I would appreciate any suggestions, so please leave them in the comments below. Check out my website at thespanner.com for more than 850 in-depth fundamental tutorials on personal finance, investments, and economics. Check out my books on money at williamspalding.com. Thank you.